Can you hear me? Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh. We can hear you, sir.
Thank you for this rare privilege to have opportunity to discuss a vital topic with all of us. Alaikum once again. My name is Bashir Oladunni, MD CEO of WEMABOD Limited, as already introduced. I'm glad to be given the opportunity to speak with us on the topic real estate investment for financial success. As we all know, the three basic needs of man, food, clothing, and shelter, are of utmost importance to every human. However, shelter, which we also refer to as housing or real estate, has its own peculiarities. And we must, as individuals, begin to understand fundamentals of real estate investment so that we can tap from the advantages and benefits from the output of investing in real estate. Next slide, please. So, to put context to what we want to discuss, the objective of this discussion are five in nature. Number one is that we want to enlighten ourselves as officers on real estate wealth creation. How do you, through real estate, create wealth that will be sustainable? Secondly, we also want to address the issue of mobility and deployment constraints. It's a known fact that as military officers, we consistently have to be moved from one station to the other. And this on its own, it's a major constraint. So we'll look at it. Thirdly, we also want to identify active and passive investment strategies. And we are talking of passive and active investment strategies because of the second objective, which is the issue of mobility and deployment constraints. We understand that we are not stationed in a particular location. So how do we then invest in a way that our investment does not go down the drain? So we'll look at some active and passive investment strategies that we can deploy variously. Number four, we want to introduce us to institutional investment opportunities. There are individual investors, there are individual developers, there are individual companies, private people that carry out real estate development. But there is need for us to understand the advantages of understanding or knowing institutional investment opportunities that will help us to guarantee our investment. And lastly, we'll try to provide practical roadmap for junior officers who are either just starting their career or are in the middle of their careers or are at the tail end of their careers, such that by the time they are leaving the service, they have something to fall back on. Next slide. So those are our objectives for this 45 to 1 hour discussion that we want to have. So why real estate in the first instance? Why are we talking about real estate? Why are we not talking about other sources of investment? There are various sources of investment that you may want to do, but why real estate in particular? One of the reasons why we are discussing real estate is because it's a wealth creation. It's already proven that tangible asset that provides protection against inflation and generates passive income. Real estate is tangible. It's something you can see, you can feel. So it's not like Ponzi scheme where you are not even sure of where your resources are. So in order to create wealth, we are discussing real estate because we can see it, we can hold it, it's transferable. It's a legacy asset with strong capital appreciation. It then means that if you buy a real estate today, you are rest assured that in the next few years, the real estate will have appreciated in value, and you enjoy capital appreciation. It's also a transferable asset. It's a legacy asset that can be transferred from one generation to another generation and to another generation. So that is why it's essential for us to look at real estate as an investment that each and every one of us are advised to focus on as we move on in our career. Secondly, why are we talking about real estate? Because of security. Unlike many other instruments, it's physical asset that provides retirement security. It is secured, and you can always know whether that asset is still existing or not. So those are the two reasons why we are looking at real estate as a kind of investment, as a strategy for us to continue to save and invest in when we are still in service, so that we can have something to fall back on at the end of the day. Next slide. So, like from some of our objectives, we said we will be looking at the constraints of military officers. What are the constraints of military officers? What debar military officers from getting involved in real estate? Like the president said in his opening remark, he mentioned the constraints because of the rules and regulations guiding the services in the military that prevents military officers from seeking to be engaged in businesses that will obstruct their commitment to service. So one of the unique constraints of military officers is frequent postings. This month, Officer A might be in Kaduna. The next month, you don't even know where they will be posted to. So that on its own is a challenge to you wanting to actually invest in real estate, because we are not too sure if you will be stable in that kind of location. So one of the unique constraints to military officers is frequent postings, and that you cannot avoid it. It's part of the rules and regulation for military officers to move around because of the nature of the service they render. Number two is limited supervision time. Even when you are not moved from a certain location, the call requires that you are focused on your job, you are focused on your training, you are focused on the service you render. So you have limited time to even say, okay, I have a real estate, a land somewhere. I want to start supervising to see that the project is moving on time. The likelihood is that even when you try to even invest, maybe you buy the land, likely is that you might even forget about even having that land if you are not careful. So limited supervision time is a unique constraint. Then difficulty monitoring projects. Like I said, monitoring the progress of the project, because there is trust deficit in the society. So the challenge of monitoring projects may debar military officers from wanting or willing to invest in real estate. High reliance on trusted partners. We've seen a lot of situations where people, even those that are in the diaspora, will entrust building construction, purchase of land on family and friends. And by the time they will come back into the country, they found that they've not done anything with the funds they have sent to them. Even in some cases, we've seen cases where they even go ahead to take pictures and videos of another site, of another person's site, sent to their family abroad to convince them to send more money. And at the end of the day, nothing will be there to show for it. Lastly, another unique constraint of military officers is the need for stable long-term income. They are mostly based on salary, and having long-term income that will help you to be able to achieve your desire to own a house is a challenge that the military officers face. What are the implications of all these unique constraints? One is active investment becomes difficult. Active investment becomes difficult. That means even if you are investing, the time, because of all the constraints that we have mentioned above, it will be difficult for you to be actively involved in investment. And what this does at the end of the day, in most cases, is to increase the cost of that investment, if at all it will take place. Is to also slow down the time of the delivery of the project because you are not actively involved in the investment. The second implication of all these unique constraints that we have mentioned above is the high exposure to operational risk. Operational risk are daily activities that occur during the construction, during the process of acquiring a home. And because of the busy nature, because of the nature of the military officers' assignments, it's highly difficult for them to, they face a lot of operational risk. Operational risk either from the contractors, from the consultants, from all the stakeholders that are involved in the process of starting and completing real estate endeavor. So high exposure to operational risk is also an implication on the unique constraints of military officers. And lastly, increased vulnerability to fraud and mismanagement. So because of these unique constraints that you face, in most cases, you are likely to be exposed to fraud and mismanagement by third party that you entrust your resources on. And because resources are very scarce in nature, to save money in the current economic situation takes a lot of discipline and effort. So for someone to have taken, to have disciplined him or herself to the extent of saving money, then it's very necessary for us to have this kind of conversation around how you can protect your investment despite the constraints that you have as military officers. So we'll go to the next slide, please. I spoke about active and passive real estate investment. So I will take a look at what I refer to as active and what I refer to as passive. Active real estate investment are those kind of investments that you are practically involved in executing. One is land flipping. Land flipping is a situation where you buy land for the purpose of selling as soon as there is appreciation in the value of the land. So that kind of investment strategy is an active one because you are actively involved. You must have inspected the land, paid for the land, obtained all the necessary documents, and wait for some time for it to appreciate. Then once it appreciates, you look for buyers and then you sell and move to another location. So that's an example of active investment in real estate. Another example is property development. In this case, you acquire land for the purpose of developing it. Start from obtaining all necessary documents, that's the title documents, all necessary approvals. Then you put together the construction team, having known the cost that how much it will cost you to develop it. Then start your development either in phases, or if you have the resources, you go heads on to ensure that you complete the project on time, cost, and quality. That is another kind of active real estate investment approach. The third one is short-let rentals. Short-let rentals, very common these days, that instead of you developing and having tenants that will stay there for long, not paying your rent as a when due, you can have short-let rentals approach. That means you have serviced apartments. That gives you respite from having tenants that will not pay your rent and you remain in court for too long because of the challenge of the judiciary system in the country. So short-let rental is another kind of active investment approach that you can do. So all these kind of active investment approach that we mentioned offers higher margin, but requires significant time. It offers higher margins because you are actively involved. You understand what it costs you, and you now determine the margin that you can place on it. However, it requires significant time. And because of the nature of the services that the military officers render, that is why it's important that we look at the passive income, passive investment approach. Passive real estate investment approach are those investments in real estate that does not require you to be there physically. It does not require you to be involved in the day-to-day operations. It does not require you to be involved in monitoring. It does not require you to be involved in decision-making. But yet, you still enjoy streams of income. One of it is rental income. Rental income, where you invest in a property. Perhaps maybe you bought a property and you are enjoying rent from such property. There is also the issue of REIT-like investment. The REIT is an investment vehicle that enable an individual to own part of a big investment. What I'm saying is that, for instance, in a REIT arrangement, you have the individuals coming together in an SPV, a special purpose vehicle is created to drive the REIT approach. Real estate, it's called Real Estate Investment Trust. It's a trust. Investors are entrusting their resources into a special purpose vehicle. So what that does is that, for instance, the special purpose vehicle might own a building of 20-story building, and you have individual investors having units in that investment, and at the end of the day, they enjoy regular dividend from the proceeds of that development. What that, like I said, does is that it gives individuals who ordinarily will not be able to afford the cost of putting up that kind of big edifice to also be part owners of those kind of investments. It's becoming more relevant in the Nigerian system. We've had 3, 4, 5 companies floating REITs in the recent time successfully. So it's a kind of investment that guarantees regular income. However, the kind of investment, the kind of properties real estate that goes into it are real estate properties that guarantee regular and secure rental income. Once that kind of asset cannot guarantee regular rental income, it does not qualify to be put into a REIT. The REIT is also guided by regulation because of the need to protect individual investors' investment. It is guided by the Nigerian Stock Exchange. You have to put it on the Nigerian Stock Exchange. There are private REITs from certain level, but once it's come to a public, it becomes, you have to get it registered with REIT. The process involves a lot. You have to prepare your prospectus that will describe the kind of investment you want to put money into, describe the company itself, talk about the title of the property, look at if there are any risk that you need to disclose. There must be good disclosure for you to float a risk. That's another kind of passive kind of investment. As military officers, you are not bothered with how the building will be constructed. You are not bothered with how such building will be managed. You are not bothered with whether anything is. All you are concerned with is that at the end of the year, the rental income, having let out all the basic expenses that occurred during the year, the balance comes as dividend that will be paid to all unit holders. in the REITs. Thirdly, we have property syndication, Property syndication is where 2, 3, 4 people come together to put resources to develop a property. It is similar to REIT, but in this case, syndication does not really mean it has to be registered with the Nigerian Stock Exchange. 2, 3 people that understand themselves can come together to put up a property, and at the end of the day, they begin to enjoy the rental income that will be shared amongst them based on the proportion of their investment. Just like you have an apartment, 2, 3 officers can come together to buy an apartment in a choice location with good rental income, and they agree on how to share the rent on annual basis, having deducted the expenses that they incurred that year. That will give opportunity for you that you are not involved in the daily management of the property, but you still enjoy income on regular basis from that investment that you have come together having 2, 3 officers. For instance, if the apartment costs you 20 million, for instance, you can have 5 officers pull together for 4 million, acquire the apartment, and give it to a management company to manage on their behalf. At the end of the day, when the rent comes in, let's say the rent is 2 million annually, they deduct the cost of management of that apartment, say 10%, the balance will then be shared as agreed by the 4 syndicates in that kind of investment. We also have a joint venture. Joint venture comes in different ways. A joint venture arrangement comes in different ways. It's either you have a land as the land partner, you don't have the fund and you don't have the technical know-how to carry out the development. So you go into joint venture with another partner that has the finance to construct and also have technical ability to develop the project. In that case, you as the officer that owns the land, you are passive in that arrangement because you are not involved in the day-to-day construction. That gives you the benefit of earning an improved revenue at the end when the project is completed. However, getting involved in joint venture arrangements also requires you to have good knowledge of how such arrangement is constituted. Otherwise, you could go into a joint venture and come out with negative results. So it's important for you, if you want to go into such a joint venture, if you have your land, to profile the other party. Profile the other party that you want to go into such joint venture with. One, for you to know the financial capability of such person. A lot of people will come around to tell you they have the financial resources to develop your land. And at the end of the day, once you sign off, you find out that they don't have that resources that they claimed to have. So you must be sure that such a person has that kind of financial wherewithal to do the project. Secondly, is to profile, look at the history of that partner that you want to go into joint venture with. What has the partner done in the last few years, say in the last 5 years? Has that person done has that person done similar kind of projects? I'm using the word similar, I'm emphasizing it because if your land, if for instance what you want to do is a 10-story building, you will not be helping yourself if you go into a joint venture with somebody that has not done more than 3-story building before, because the technicalities involved in getting a 10-story building built is different from getting a 3-story building built. So part of your findings will be, okay, you've done projects in the time. I want to see your past projects that you have done. Are they of similar nature in terms of use? are used in terms of, are they the same as residential, commercial, retail? For instance, if you have a land that you want to develop a retail mall, and then you are looking for a joint venture partner, that joint venture partner must be able to show you history of number of malls that he or she has developed directly or indirectly. So that you need to profile that company. You also need to request for the company registration CAC particulars so that you can unveil those behind the company. The reason is that if you don't unveil the people behind the company, you won't know the kind of caliber, the kind of personality that are behind the company. And that has helped most people a lot in the time past. Because once you unveil the people behind the company, that will tell you if there are people that you have dealt with in the time past that are not of good character. And at that point, you move away from that kind of investment. And lastly, you also have institutional rental housing. Institutional rental housing is a new phenomenon in Nigeria, where companies that have been in real estate for long and have become institutions invest largely in rental housing rather than investing in housing that they will build and sell. They invest in housing that will continue to generate income for them annually. Those type of housing are things like student hostels. Investment in student hostels is a good kind of investment that can guarantee a regular source of income. However, you also need to understand the nitty-gritty of investment in student hostels. Student hostels are of two categories. It's either you invest on campus or off campus. What it takes to invest or to manage those kind of investments on the two kind of investment differs from one another. For the one on campus, you need to understand the rules and regulations guiding construction and development within the campus. You also need to understand if the school has rules and regulations guiding the maximum amount of rent that you can charge. Because if you are constrained by the amount of rent you can charge, it then means that you may not be able to recover your investment within a reasonable time. Investment outside of campus, as good as it is, it gives you liberty to fix your rent anyhow. It also has its own challenges of you not being able to track the students that you have in the hostel, and of you not being able to recover your rent should they be owing you. The rental income from the one on campus is better guaranteed because in most cases, the way it's structured is that they pay it alongside their school fees. So once they pay the school fees, they pay your rent and you get your rent. And so as officers, we can as well invest in student hostels, and you can scale it. You can start from even student hostel of 6 rooms. You move from 6 rooms, then you add additional rooms, and you continue to do it along that way. So those are the examples of passive real estate investment approach, which to me is more suitable to the kind of services that we render because of the time constraint that we have in military service cycle. So we've talked about the active investment approach. We talked about the passive investment approach. Let me also state that the fact that you are busy, you don't have the time, does not mean you cannot get yourself involved in active real estate investment approach. It's just for you to understand what you want to do and move towards it. So we've talked about active and passive real estate investment approach. Can we go to the next slide? So now, in choosing your path and considering which one to go for, either you want to go for active or passive, there are some factors that you need to consider. One of it is time requirement. For active real estate, the time requirement is very high. For passive, it's very low. So as military officers willing to invest in real estate, we need to consider this. Do you really have that time for you to be involved in the construction, monitoring, supervision, procurement, and quality control that is involved in you getting actively involved in real estate? So the time requirement for active real estate investment approach is very high. That of passive is very low. The risk level of actively getting involved in real estate is high because you are bearing the risk 100%. But for passive real estate, is moderate in the sense that the risk will be shared by a lot of people that you have come together to do the investment. So you have shared the risk, that mitigates your risk. Then in terms of control, another factor, the control that is required for you to choose the active real estate investment approach is high, while in the case of passive, the control is structured because you have people there that will be involved doing it. And in terms of income stability, that of active is not certain, is uncertain because you are actively involved. The income stability is not certain because in most cases you are not a subject matter expert. You may not really understand why certain decisions must not be taken and why certain decisions must be taken. But for passive, because you have entrusted it in the hands of experts in that industry, you can predictably determine your income as it goes, and you can plan towards that income. So having looked at the active and passive income and factors that are to be considered, so I will advise that as officers, military officers, we consider these factors before we take a decision on which of these two approaches we want to adopt in our investment strategy. Next slide. So for officers, this slide speaks to the investment journey for officers. As officers, how do we start investing? How do we initiate investment? How do we scale it up? Then how do we continue to monitor it to ensure that we get benefit from it? So for junior officers, I will advise that we start from land banking. What do we mean by land banking? Land banking is a situation where you identify land mostly in the green area. Green areas are areas that are yet to be fully developed at the suburbs of the town. Because of our level, it may not be financially possible for us to be able to finance getting land within the city centers. So it's advisable for junior officers not to mind location. Every location at time will turn to a city because development is like a living cell. It goes on daily basis. So never mind that you have land in where you call in the bush. So start with land banking beds in the suburb of the city, not in the city center, because of the level the junior officers are. Then another approach is that you can also invest through cooperatives. Cooperatives come together to acquire large expanse of land at the suburb, like I said, and the advantage of that is that there is active control. We have cooperative officers that will be monitoring and supervising the process of acquiring the land. So you as a junior officer, you will not be violating the rules and regulations of the military by not focusing on your assignment, because that aspect of the transaction would have been handled by officers of the cooperative. Another advantage of buying through cooperatives is that you have the advantage of economic of scale, because we are buying at a large expanse of land. The intended possibility is that you can buy it cheaper than you would have gone all alone if it's an individual. For instance, if a plot of land will cost you 10 million and you are going as a cooperative to buy 20 plots of land, at the end of the day, because of you are negotiating, you are doing a bulk purchase, you are likely to get economic of scale. Land that you ought to have bought as an individual for 10 million may at the end of the day come down to 5 million if the negotiators are smart in their negotiation. So advantage to junior officers in investing in land banking through cooperatives are what I have just explained. Then maintain financial discipline. This is very important and crucial. If you look at our pay slips, there is no employer, there is no government that will be paying you. When you look at your pay slip, you won't see savings allowance. You never find savings allowance. What you are being paid as an employee, what you are being paid as an officer, is an amount that will be at least good enough to allow you to do to carry out your activities, to do your job as an officer or as an employee. No employer pays you an amount that will enable you to save, and that is where financial discipline comes to play. Rather than buying phones that are very expensive, some phones today are like 2-3 million, and such an amount can get you land somewhere. Take for instance, if two officers were given 3 million today, and Officer A bought iPhone for 3 million, Officer B bought a plot of land for 3 million. In the next 2-3 years, because of taste and technology, innovation, that iPhone that the Officer A bought for 3 million would have run out of vogue. And what happened is that in the next 2-3 years, Officer A would have gotten tired of the phone because other phones with better functionality would have been developed. So he will be looking out for getting another phone. That phone, and in 3 years' time, if you take it to the market, the phone you bought 3 million, if you take it to the market, it will have depreciated, and you can't get it sold for more than maybe 500 or 800,000 naira. Unlike Officer B, who invested that 3 million in land, in the next 3 years, that 3 million, depending on the real estate activities, real estate dynamics within that environment of that land, the minimum that person will be looking at, the land would have appreciated from maybe 3 million to 5, 6, 7, 8, 10 million. So we must maintain financial discipline. We must sacrifice today for tomorrow. We must sacrifice today for tomorrow to be able to invest in investment like real estate that will be there for us tomorrow. So for military level, for middle level officers, it's advisable that you scale through partnerships. What this means is that because as middle level officers, your take home is likely to be more than that of the junior officers. One, as middle level officers, you must have spent a longer time in the service than the junior officers, so you must have understood how things work in the service. You must have been enjoying certain privileges that the junior officer does not engage. So you can involve in a scale. You can scale through partnership. That means you can engage in partnership in developing real estate and even buying large expanse of land through partnership. And you can enter into structured investment. Structured investment means perhaps maybe you have a property that is to be sold for 10 million, and what you have currently is just 2 million. You can deposit the 2 million and structure the balance over a period of time. And you can even go into that investment at the very beginning of the construction, which most cases we call off-takers. When you come in early, the price is cheap, is reduced, then you have opportunity to also structure the payment. in a way that it does not affect your daily expenses, it does not affect taking care of family or your daily needs. So you structure the investment. So those are the two approaches that I will be recommending for mid-level officers. For senior officers, because they are nearing retirement, their own focus, one, should be on rental income. If you are nearing retirement, all your investments that you'll be doing must be such that will give you rental income. What that means is that buying land may not be the best option at that time, except if the purpose is for you to buy land and flip. But because at retirement you need regular income, your expenses will increase, your medical expenses will increase, a lot of things will come up because of old age too, so you need regular income. So as senior officers, the best approach, one of it is that you should focus more on rental income, property investment that will give you rental income on yearly basis. I've talked about them. I've talked about institutional rental housing like student hostels, involved in invest in student hostels, invest in REITs that will give you dividend every year, which is just some part of the rental income that property is generating. Another investment approach that I also want to recommend for senior officers is to invest in completed assets. Because you are nearing retirement, don't invest in assets that are just being developed because of the risk of abandonment. If you have put in all your resources while in service in a project that's just being developed, and you are not careful, you are not mindful, you don't know the quality of the developer, you have not investigated the pedigree of such a developer and his ability to deliver on time, then the chances are that upon retirement, you will still be struggling with getting your investment back because the project has not been completed. So for senior officers, it's advisable you invest in completed assets. However, despite that they are completed, it does not mean you cannot still structure your payment. It's all about negotiation. Even if you found a completed asset, you can negotiate your payment plan with the owner of the asset. So those are the kind of investment approach or journey that I would want to recommend for the three categories of officers that I've mentioned, for junior officers, middle level officers, and for senior level officers. So this journey, again, applicable to all of them. At the entry stage, land banking in developing area, like I explained, you invest in land banking in developing area. You can, because of the huge financial exposure of real estate, you may not be able to afford land within the city center and the already developed area, but you can actually invest as an entry stage in the suburb developing areas where you can get land from 1 million up to 10 million. Then growth stage. At the growth stage, you move to small rental properties and cooperative partnership. That's as you move on in your career. Then you move to institutional assets, professionally managed, high-yielding projects, e.g. with companies like WEMABOD. So you move to that level, and finally, you have financial independence. The thing is that if you're able to run through this journey as an officer, you start at the entry point by land banking, you move to growth by investing in small rental income, then you advance to institutional asset investment. At the end of the day, what you get is that you have financial independence. Upon retirement, you have financial independence. Why? Because you have a diverse portfolio generating income that replaces your salary. You must work towards putting in place investment assets that are capable of replacing your monthly salary, if not more than what you earn monthly. If not until you are able to do this, you will not have financial independence upon retirement. Yeah, and if you don't have financial independence upon retirement, you are likely to become a nuisance to officers that are still in service, because you keep going back to them to request for assistance, and this you are likely to face challenges of how to manage your health, because as you grow old, you need more attention to your medical condition. You are also likely to face challenges of how do you even maintain your home as a father, or as a husband, or as a mother, or as a wife. So it's important that we understand this journey and we start now. We don't wait till tomorrow. And like I say, you don't have to have the billions. The mistake most people make is that they keep saying, not until I have money to purchase or to buy a house, I will not invest in a house. I have a true story, a life story of an MD of an establishment and the driver. While the MD was living in a rented apartment, insisting that not until he's able to get enough resources, he will not leave. He was in a rented apartment for 10 years, hoping to get resources to buy his own house in Ikoyi. Those resources were not coming. He was shocked on a day that the driver was doing a naming ceremony and he had to attend. It was until then that he realized that within the little salary that the driver was earning, the driver had 3 properties, 3 landed properties. Let's forget about the size. Let's forget about the quality. There is no small landlord. Like I tell people, there is no small landlord. Even if you own a 10 square meters of land and you have just 1 block on it, and they are having community meeting, landlord association meeting, without you being there, the numbers are not complete. You are also a landlord. So there is no small landlord anywhere. That was part of what we should take away from this conversation, that there is no small landlord anywhere. Don't be timid. Don't be shy to say, okay, I just want to have 1 plot. I want to have a quarter plot in this quarter plot in an environment. Invest in it. Wait for it to mature. Then you can then offload or you develop it to continue to enjoy your rental income. I hope I've been able to speak to how junior officers, middle officers, and senior officers can start thinking of how to start their investment, and the journey from day one at entry point up to when you become financial independent. Can we go to the next slide? What are the financial options that are available for us to finance real estate? You know, I've said real estate investment is capital intensive, but are there ways we can be strategic in financing the real estate investment of our choice? One is cooperative contributions. We must, as officers, join the cooperative of our base. We can join more than 1 cooperative if we choose to. So, but it's important we join cooperative and we make our contributions as and when due. And again, we must also participate in the activities of the cooperative. And what that gives us is that I want to believe that for us to have decided that we want to discuss this subject matter, investment in real estate, I want to believe that we all have passion for real estate. We understand the advantage of real estate investment. We want to be able to see ourselves in the future being financially independent through our various investments in real estate that guarantees and continue to guarantee regular rental income on annual basis or on monthly basis that will represent our salary and even higher than our salary at the end of the day. So since this is the kind of thing we have a passion for, we should participate actively in the cooperative operations and activities. And what does that give us? That will give us opportunity to convince the cooperative members, to convince the cooperators on also investing in land. Because if those that are running the affairs of the cooperative society or association are not inclined to real estate as an investment. The tendency is that what they'll be doing is that during festive period, they invest, they buy commodities, they buy rice, they buy beans for cooperative members to buy into, they buy household equipment, TV, fan, and all these things that they are buying, that we are purchasing, we pay back over a time. And those things, like we explained earlier, they are items that depreciate over time and they become liabilities. So if, as members of this group, we participate actively in our cooperative society activities, we will be able to influence their decision around investing in real estate, and that is a major source of financing our real estate investment strategy or intention. And you will understand how cooperative works. You must have contributed for a number of months or years, depending on their rule, before you can have access to benefit from the corporation. I think you can benefit maybe 150% or twice what you have contributed. And the advantage of cooperative contribution is like, unlike conventional banking or mortgage approach, where you require to bring collateral before you can get loan. For cooperative association, you don't need collateral. All you need is to get somebody within a week or two amongst them that will sign guarantee for you, and that is very easy and simple to get amongst ourselves, because we are all members of the same group, we are all members of the same military service. We understand ourselves. So that is one of the ways by which you can finance your real estate investment opportunity. And not only that, wait till the cooperative is able to buy land. Even if you get private land that you want to buy, you can still approach the cooperative for loan. I mean, you can, assuming you have 1 million in cooperative, and you get a land that you want to buy for 1.5 million, you can approach the cooperative to give you that 1.5 million, and so that you buy the land, and you continue to pay, I think sometimes over 2 or 3 years, which is at 1-digit interest rate, mostly 7%, 8%, depending on the nature or type of cooperative. So cooperative contribution is one of the options through which you can finance your real estate investment objective. Number 2 is mortgage financing. Mortgage financing is a bit complicated than the cooperative contribution, in the sense that it is regulated by law, and it has a lot of stages. Mortgage financing has different types. You have mortgage financing from commercial banks that I will not encourage any officer to want to attempt to go into because of the complexity. One, you will be required to submit a collateral. Collateral means you are required to submit an asset that is worth twice the amount of loan that you want to secure. For instance, if you want to secure a loan of 1 million, you are expected to come with a collateral that is worth 2 million. In most cases, collateral are also properties. Your title to your property that you drop it as collateral for you to be able to secure that. Currently, the interest rate for commercial banks, minimum of 23, 25, some even up to 30%. And I don't think that is friendly to any real estate investment. It's a mismatch for you to want to invest in real estate, especially at this low level, and you are thinking of approaching commercial bank. But it's just necessary for us to discuss it so that we can understand that, and as well, especially for the senior officers who have more revenue, who have more salary, they might want to consider commercial bank. But before you make a choice of the kind of mortgage finance that you approach, you must weigh various options to be sure the one that best fits into the kind of real estate that you want to do. If what you want to do is to buy and sell almost immediately, if what you want to do is to buy land, develop it, and sell immediately, then maybe you may be considering commercial bank mortgage facility as an option. But if the intention is to build and continue to enjoy rental income over for the rest of the life cycle of the property, then it's not advisable at all for you to go into getting mortgage facility from commercial bank, because even the interest on the loan alone, your rental income, annual rental income, will not be able to pay interest, let alone paying principal at the end of the day. So commercial banks mortgage are types of mortgage financing. Another type of mortgage financing that is available to us is from Federal Mortgage Bank. Federal Mortgage Bank as officers, as employees of established institutions, you are expected to register with National Housing Fund and make your own contribution on monthly basis to the National Housing Fund. When you register with National Housing Fund, it gives you opportunity to be able to access loan from Federal Mortgage Bank. But you are not approaching the Federal Mortgage Bank directly. You'll be approaching Federal Mortgage Bank through what we call primary mortgage institution, primary mortgage bank, PMB, primary mortgage bank. We have a lot of primary mortgage bank around, but before you now also register with primary mortgage bank, it's also very important to find out and confirm that that primary mortgage bank is duly registered by the Federal Mortgage Bank. We have a lot of primary mortgage banks that have been delisted by Federal Mortgage Bank. So you need to be sure that the one you want to register with is one that is still confirmed by the Federal Mortgage Bank as still existing as a primary mortgage bank. So what primary mortgage bank does is that they create mortgages, a lot full of mortgages. They have a lot of people that require mortgage. They bring them together and approach Federal Mortgage Bank on behalf of those people that need the mortgage. Federal Mortgage Bank releases the fund to primary mortgage bank and they disburse to interested parties. But they don't just disburse directly like that. What they also do is that, for instance, if I want to buy a property that is worth, I think the maximum you can do now with Federal Mortgage Bank is 25 million. Any property between 1 million to 25 million, then you can access it from Federal Mortgage Bank to the National Housing Fund and to a primary mortgage bank. So what they do is to request you to, one, the property you want to buy must have a valid title, and there must be an offer from the seller to you, the buyer, stating the price that is not more than the maximum that you can get from Federal Mortgage Bank. Once you get that, your contribution will be profiled, and now it's even easier now because the law now permits you to use, because again, for you to access that loan, you'll be requested to put down 20%. If the property is 1 million, for instance, you are expected to put down your own equity contribution of 20%. So what the law has now permitted now is that they found that most people are not approaching or are not accessing that fund, that Federal Mortgage Bank loan, because in most cases they don't have that 20% to put down as the initial, as their own equity contribution. So what the law has now permitted is that your savings over the year, I said you must be part of National Housing Fund and you'll be contributing every month to the National Housing Fund through your various employer. So your savings over the year, the law now permits that you can use part of your savings over the years to pay for the 20% equity contribution. And that brought a very great relief to individuals that want to access mortgage. So once you pay that down, the primary mortgage bank will do their necessary homework to ensure that the title that you want to buy is good and transferable. Once that is done, you access your loan, but the document, the transfer document that will be prepared between you and the seller will not be handed over to you. It will be handed over to the primary mortgage bank that now serves as collateral against the loan that you have collected, and you continue to repay the loan from your national housing fund that you do every month, or if you have money from other sources, you can have a bulk payment as a remittance until you finish paying that loan. That is when the title will not be released to you. As meanwhile, you have owned the property, you are living in that property, you are enjoying rent revenue from the property, but it's only that the title that gives you legal rights and ownership to that property will still be with the primary mortgage bank and will be handed over to you as soon as you pay off discharge your loan obligation on the property. So mortgage is a way by which we can finance our real estate objective. We also have individuals that also gives out mortgages, although they are on the very high side. In the recent time, there is this MRIF, Ministry of Finance and Incorporation, that has just, the federal government has just introduced. MRIF is a way of helping homeowners to access loan for them to finance their home investment objective. How this works is that they finance developers who are developing real estate. Initially, the rule was that that project must have been completed to 75% before such developer can, or before such people that are interested in mortgage can use that property to secure mortgage. It must be have been completed to 75%. What they were trying to avoid is a situation where they will release money to developers and that property will be abandoned, and jeopardizing the interests of those of us that are seeking mortgage for to be able to secure our homes. So, but now it has now changed again, that it must be completed on near completed buildings. So if you see a completed block of flats or near completed block of flats that you are interested in, you can access it through MRIF. All you need to do is to send details of that property to MRIF platform, or if you go to the MRIF website, you will see different properties that have been uploaded that are qualified, that have been accessed to be qualified for you to access loan. So go to MRIF website, you will find a lot of properties there that are already qualified, and it gives you opportunity to access maximum of 150 million. But the 150 million will not be given to you. It's a kind of guarantee. We call it off-takers guarantee for the developer. It will be given to the developer to complete the project, and the maximum is 150 million. So it then means that you cannot access MRIF unless that project is worth between 1 million to 150 million in cost. Another thing is that for you to now be able to access it, your age, the number of years, your salary level will also be taken into consideration for it to determine the maximum amount that you can access. So that is as far as mortgage financing is concerned. Joint ownership is another way of financing our real estate objective. I've talked briefly on that earlier. Joint ownership is where 2-3 people come together and bring together their funds. In this case, what they are bringing together are what we call equity contribution. It's not debt financing. Mr. A has 2 million, Mr. B has 3 million, Mr. C has 4 million. They bring together their funds, that is 9 million, to buy a property, and they now decide on how they will apportion the benefits, either in terms of rental income or in terms of capital amount, if the objective is to buy the asset and sell almost immediately. The advantage of this is that it eliminates the problem of interest payments on loan, and it reduces the pressure on the investor to be running around chasing how they want to refund or pay back the loan that they have obtained. So that is one of the major advantage of joint ownership. You are all jointly responsible for putting resources together to develop the asset. Another method of financing options for real estate investment objective is government housing initiatives. Government have a lot of housing initiatives that they put together. Lagos State government used to have rent to own. The rent to own scheme is a scheme that allows you to have access to a house and continue to pay rent. That rent that you are paying is used to pay back the cost of the house. For instance, if the apartment is sold for 5 million ordinarily, the apartment is being sold for 5 million ordinarily, government can sell it to you at 6 million and give you access into the apartment to be living there or even rent it out and be enjoying and be paying monthly rent to government. That to now defray the 6 million. Government has also benefited from that transaction because ordinarily the apartment would have cost 5 million. They have sold it to you at a margin and sold it to you for 6 million. But you now have opportunity to spread the repayment of the 6 million over a period of say 10, 15 years while you live there or you let it out as a tenant. So that is a rent to own scheme. I think the Lagos State government did this for some time. I'm not sure it's still on now. We also have the family funds scheme that the federal government also introduced at some time. Then we have the current one, the renewed hope agenda. The renewed hope agenda, housing agenda, is also to help citizens at various levels to be able to access housing using one-digit interest rate and having opportunity to pay over a long time. And we also have structured payment plan. Structured payment plans can occur either as an off-taker or in buying already completed building. Like I explained earlier, you pay an amount, maybe 20, 30%, then you spread the balance over a period of time. So these 5 approaches are financing options that are available for us to access finance for our various real estate investment objectives. Can we go to the next slide? So in anything in life, even as we wake up, and I know we do understand that better as Muslims, everything in life is risky. There is nothing in life that does not have its risk elements. But the fact that something is risky does not mean we should not go into it. All we need to do is to put in place strategies to mitigate such risk that are inherent in any decision that we want to take. So one of the ways to mitigate risk in real estate investment of our choice, because when you buy land, you have a lot of risk that are associated with it. Is it from you even ascertaining whether you are buying from the right person? Is it even the problem of multiple ownership, a third-party claim to that land? Is it in the area of even the texture of the land? The texture of the land. Is it even whether that land is even under government acquisition or not? So there are so many numerous risks that are associated with investment in real estate, typical of other kind of investment too. There is no investment that is free of risk. We just have to understand those risks, know the ones that are of high impact on our decision, know the ones that are of low impact on our decision, then map out strategies on how we can mitigate all those risks and plan towards it. So one of the ways to mitigate risk in our investment approach is due diligence. We must always verify title documents. and partner only with credible developers. We must always verify title document. Mistake that most of us make is that once we see that we have an investment we want to do in real estate, be it land or property, the first thing we do is to approach a lawyer. Lawyers are very important and germane in investing in real estate, but they are not the first subject matter expert that we should engage. The first subject matter expert is a land surveyor. In my own opinion, from my experience in practice, is a land surveyor. Because even before you even make payments, before you go into even investigating the title, it is very important for you to ascertain whether that land is under government acquisition or not. So that's the first thing. Get a copy of the survey plan. Get a land surveyor to help you chart that land from the Surveyor General's office of whatever state you are investing, and advise you whether that land is under government acquisition. There are also two types of acquisition. If the acquisition, we have committed acquisition. Committed acquisition are acquisition that the government has done, land that government has acquired, and committed for certain use or uses. Such kind of land is not a land you should go into at all. No matter how beautiful, how fantastic the investment is, please stay away from it. It may not come today, it may not be tomorrow, it may not come in 5 years, it may not come in 10 years, but the time will come that the government will come in and evict all those people on the land. You can see what is happening along the coastal road. You can see what is happening along the rail line. You can see what is happening on various areas where government had acquired in the time past, but because of ignorance or because of the need, because of ignorance or because of greed, because sometimes it's because of greed. Like I tell people, one of the due diligence, one of the risk mitigants that you must look out for, risk factor, red flag, is when suddenly you consider that this land or this property seems to be unreasonably cheap, then you need to be very careful. Anything cheap is not good. Anything good is not cheap. That has been my own principle in life. Anything cheap is not good. Anything good is not cheap. So once because if somebody tells you, I have a plot of land to sell in this kind of location, I'm selling for 20,000 naira. And from your investigation, you find that be careful, watch out, so that you don't get duped. So firstly is that you get a land surveyor to confirm whether that land is under government acquisition. I've talked about the first type of acquisition that has been committed. In that case, no gray area. The second type of acquisition is acquisition that is not committed. Acquisition that is not committed can be seen to be a good buy. However, you need to confirm whether, because acquisition that is not committed can be regularized. Those ones are the ones they call regularization, that can pass through regularization. In that case, you will need the land surveyor to apply for consent to survey. Consent to survey. If he's able to get the Surveyor General's office consent approved for him to carry out the survey, it then means that that land can be regularized. So if you bought such a land and you submit your title for perfection, then it will go through regularization and you have a valid title. So firstly, part of due diligence confirm whether that land is under government acquisition or not. Secondly, do your physical inspection to look at the texture of the land. Some soil are so bad that you need to pile before you can develop. And you have to look at it in relation to the real estate economy of that environment. Some environments are such that once you include the cost of piling in your development, then the investment will go into negative. It will not be viable. So you need to do your physical inspection to be able to confirm whether that land is a solid land, or it requires some filling, or it requires piling, or it requires anything to be done. Again, you also need to look at the environment. For instance, if you are to buy a land that is beside a cemetery, if you are to buy a land that is beside a mortuary, you decide to buy a land that is even beside a church, beside a mosque, then you must understand that the quality of interested party, especially where you want to build that land, that property, for you to retain it for rental income, then you must know that the caliber of person that you are likely to get as tenants will not be the such that will be able to pay your rent as and when due. Again, is that you are then likely to experience a long period of void. Even if you are lucky to get tenants in there, the tenants will not stay for long. They will vacate, and it will take you a very long time for you to get to secure another tenant, and that will be revenue loss on annual basis. So part of the due diligence is to scan your environment, see what is happening within that neighborhood, for you to be able to know whether you should invest in the property. On title documentation too, some titles are valid at the point of purchase. They have good title. But another thing is that title transferable? We call it transferability of title documents. For instance, a man died having a CFO on a land, and the man died intestate without a will. When the man dies intestate, that means he dies without putting down any will that anybody can make reference to. And the family wants to sell such a property. Yes, there is a valid title from the original owner, but the original owner is now late. So the title has devolved over his children. Say maybe he has a wife and 4 children. What the law stipulates is that he must get letter of administration. They must apply for letter of administration from the government and get a valid letter of administration where administrators of the estate will be appointed. So it is the administrators of the estate so appointed that have the legal right to transfer that property legally to anybody. It is not that you cannot buy that property even when there is no letter of administration. I'm just trying to explain to us so that we can understand that, yes, in certain instances, we must check the transferability of the title document we want to buy. So if you don't have, if there is a valid title, but the owner is dead and there is no letter of administration, what do you do? What do you do in that case? What you do is to have what we call contract of sale with the sellers. Let them commit in writing that they will go and process the letter of administration. Then you make part payment. You make a deposit. If the property is worth 20 million, you deposit maybe 5 million, because again, letter of administration will cost them money. Why most people don't go for the letter of administration is the cost, because the government will tax you based on the value of the assets that the disease have that you want to administer. So many people run away from it because of the cost. So they need money to process the letter of administration. So you release part of the money, say 5 million from the 20 million to them, or 8 or 9 million. You can even as high as 10 million for them to process the letter of administration and give them a timeline within which to complete the processing of the letter of administration. And once that is completed, the balance will be paid upon signing of the deed of assignment by the administrators, by the legally appointed administrators. And again, once they sign the deed of assignment, you must not forget to make them sign all other necessary documents that you will now use to go and register your own title with the government. Documents such as Form 1C, they must sign their Form 1C. You must request them for receipt of payment and any other document that the authority will require for that title to be registered in your name. So for properties that have no letter of administration, you can purchase them, but you must understand what you need to do, like I've explained, for you to be able to purchase them and become a legal property owner. If you purchase without having them to do the letter of administration, you are just holding a paper. That paper is not a legal document. What you perhaps have is an equitable interest because you have made payments and you have evidence that you made payments, so you have equitable interest. But if tomorrow another person that have a legal interest, a legal title comes up and you go to court, the person that has a legal title, you have precedent and have judgment over you. So we need to watch out for that. What happens if the owner, original owner that is late, now die having put in place a will? If there is a will, how do you handle such a situation if you are to buy a property that has a will? Having a will alone does not give the beneficiaries of the will legal right to be able to transfer. So if there is a will, for instance, the trustees of the will, because the deceased must have appointed trustees, maybe his friend, his wife, some of his children as trustees. So the trustees of the will now, if the man has 5 properties, for instance, and in his will, he has given it to one to each of the children, child A, B, C, D, E, F. And he has appointed child A and B as the trustees of the will. Executors of the will, not trustees. Executors of the will. So what the executors will be required to do for child A, B, C, D to have a transferable title to each of the properties that have been bequeathed on them is that the executors will now do what we call vesting deed. Vesting deed for each of the child, vesting that property that has been willed to them onto them. So each child A will have his own vesting deed, B, C, D, E, vesting the property or properties that have been willed to them onto them. It is that vesting deed that child A, B, C, D will now take to the ministry or the authority, the agency, to register it as a valid title and transferable title. It is until then that that document, that property, that title can be transferred legally to a third party. So it's good for us to understand the various types of property, the various types of title. Again, the fact that a property does not have a registered title does not mean you cannot buy. All you need to do is to do your due diligence to be sure that the person you are buying from is the rightful owner. Take pictures when payment is being made. Make sure you document, take videos to be sure that the faces of those that sold to you are known. Sign necessary documents of the sales, and then you now take it, get a lawyer. Again, the fact that you have engaged a land surveyor, I only said the first subject subject expert that you need to contact is the land surveyor. When you have contacted the land surveyor and he has confirmed to you that the land is not under government acquisition, that is when you now request for the title document or any document that the seller has. You request for it, then give it to your lawyer for your lawyer to verify if there are no encumbrances on it. Once your lawyer gets it, your lawyer will then be able to know whether it requires a letter of administration, whether it requires a vesting deed, or whether it's a virgin land. A virgin land is a land that has not been registered with government before. If that is the case, then your lawyer will advise you on how you start your title perfection so that you can get it registered. Also common in the recent time is what we call global title. Global title are title that is given to a very large expanse of land that has been registered with the government. For instance, if you have the whole of Festac, assuming it's owned by an individual, that individual will have just one title for the entire, let's say, 20 hectares of land. That's a global title. So if you have a global title on the land, and of that global may cover about 50 plots of land, and you are just buying just one, it then means that the root of that of your title is that global title. It is that global title. From that global title, then you get your deed of assignment. In most cases, you have to go back to the original owner of the global title, except and unless if the person you are buying from had earlier gotten a registered deed of assignment with him. That is when you take it off from there. So those are due diligence that you need to find out. Part of the due diligence is also to look at the family that claim to be the owner of the property. Find out if it's a polygamous home. The approach to it is different from if it's just a one-wife situation. If it's a polygamous home, you need to be sure that all the, how do we put it, branches of the family are well represented as members that are selling the property to you. So those are due diligence that you need to carry out. You also need to carry out due diligence on the community. Are there community miscreants within that neighborhood? Are there what we call homoniles? That if you buy the property, are there homoniles that you need to recognize and take care of? So in that case, you need to do your stakeholders identification. Stakeholders identification and mapping. That will enable you to actually dissect whether or not there are issues. So from your stakeholder identification, you know those that have influence, you know those that do not have influence, and you know the ones that you have to focus duly on. Another due diligence is for you to find out the use that you can put that property to. Some land are mainly for residential. In the just last week or 2 weeks ago, someone introduced a land to us in Ikoyi. On the title of the land is for residential use. But by the time we did our physical inspection, we found that the land is sandwiched by two private cemeteries. So in terms of the highest use of that land, in our own estimation, the highest use of that land is for private cemetery too, since you have two cemeteries adjoining the land. But the document, the approval that the government, the use with which the government has dedicated that land for is for residential. And that is the best use to which you can put that property from government regulation. So we call it highest and best use. You must carry out due diligence on your highest and best use. Your highest use may not be the best use, and you cannot develop anything above the best use. The best use is determined by the town planning regulation of that locality. So when we found out that physically what you can do there is to have another cemetery, we now have to go back to the physical planning authority to find out this land that is for residential purpose, can we get a change of use? We took pictures of the environment. We did, what is it called? Drone video, sent it to the ministry to say, okay, yes, originally this land was allocated for residential use, but the development over the years has taken over that use. If you put up residential there, nobody will take it because of our culture, the fear that you cannot live with the dead. So that is where we are. Not until, and that is a gateway, not until we get confirmation, written confirmation from the regulatory body, from the agency, that the land can be changed, the use of the land can be changed to the purpose that we want to put it, then we will not move on the transaction. So in your due diligence approach, you must create gateways and checklists that you must tick before you move into. And again, you must carry out due diligence on the partners that you want to go into development. If you have developers, what has been the history of those developers? If they've said they've done 5 projects, similar projects, go and find out how long did it take them to deliver each of those projects. Did they even deliver those projects? What challenges in getting their houses allocated to them? So those are the due diligence that we need to find out of the title and the developers we want to go. Please pardon me, I took a lot of time to discuss this diligence because it's a major area that anybody who is willing to invest in real estate must understand and appreciate. Once that box is not ticked, that's the principle of the company I work with, WEMABOD. The first box is the title, clean title. Once that is not ticked, we cannot move. Second risk that we must look at, or how we can mitigate risk, is institutional security. Look for companies, developers that have established themselves credibly. Companies like WEMABOD Limited. WEMABOD Limited has been in existence for over 60 years. So in terms of legal security and transparency, for a company to have succeeded over 60 years, generation upon generation have come to manage the business and gone, then we must agree with me that there must have been a very good governance, corporate governance in place. It is when you have a company that has good corporate governance that company can stand test of time. That is why you see individual companies, developers that will come up this year, in the next 2, 3, 4, 5 years, they are gone. They are nowhere. WEMABOD has huge real estate investment portfolio that helps sustain its operations over the years. So looking out for or partnering with institutional companies gives you institutional security, and that's one way to mitigate against risk. It keeps you against risk of losing your investment. It gives you against risk of fraud. You are sure that you are not dealing with. So that's one of the ways to mitigate risk. Another way to mitigate risk that are involved in real estate is to keep proper documentation. Don't do real estate transaction, relationship, or agreement based on verbal. Trust is good, but control is better. You can trust your fellow officer, you can trust your colleagues. Perfect is good, but you must put control. And one of the control is to ensure that everything that you agree with, everything is well documented and archived. Even Islam encourages us that if you want to go into any transaction with anybody, let it be documented and involve a witness. So in your documentation of your real estate transaction, conversation, process, conclusion, make sure everything is well documented and you have somebody as a witness, either as a lawyer or any other third party to witness it and get it properly archived. Have hard copy, have soft copy to secure you against risk of third party claim in the future, risk of fire. You could have that document in hard copy and there is fire where you live, or it's even missed. There could be burglary somewhere, get it lost. So it's left with you with soft copy somewhere, or you warehouse it with an escrow agent, maybe a bank, to keep the document for you, or an insurance company at a fee. So that's another way to mitigate risk in real estate. Then ethical investment, because we are Muslims, we must not discuss this kind of conversation without referencing ethical investment. Ethical investment enabled us to invest in non-interest-based financing approach. So it enables us to avoid interest-based financing. And we have a couple of establishments, a couple of banks that does non-interest banking. We have Lotus Bank, we have Jais Bank, and some others that does non-interest banking. So it's advisable as Muslims, if you want to invest, let's approach this institution, understand the various products that they have, the one that suits into our income level, then we go into it. Then ensure transparency. Part of transparency is for both all parties to declare. There is what we call personal interest, full disclosure. There must be full disclosure. If you are going into, for instance, you want to buy a land and the land is owned by your relative, you must disclose to your partner that this person is my relation and that I have relationship with this person. So there must be full disclosure and transparency. And when we talk of transparency, sometimes don't think you are smarter than the other person. There was a time we wanted to go into a transaction with a developer, and the developer submitted a proposal to us. In the proposal, for instance, for example, hypothetically, he told us that the property can generate 20 million annually. Fantastic. But from our own in-house research and market analysis, we understood that that property can only generate 10 million. So what we did was to call the developer, work out our findings, let him be aware that this property that we did our research on generates this amount, this and this, so that instead of us just saying, yes, we can get 20 million and we go into source transaction, if we had signed off and at the end of the day, he's not able to get 20 million, then the tendency is that that project will be abandoned and we start litigation from the beginning. So to avoid litigation, be transparent enough. Don't think you are smart or you are better than the other person in terms of knowledge. Thirdly, we must invest ethically. Let's endeavor to invest in things that are allowed. We have asset management companies that are non-interest bank transaction oriented. We have Marble Capital and some other ones that we can invest in ethical commodities products that we can invest in. Then treat wealth as a responsibility. Many people treat wealth as a right, that I have a right to it. So whether or not I plan for it, whether or not I discipline myself, I must be rich. I must have assets. But it doesn't go that way. We must see wealth or treat wealth as a responsibility that we must be disciplined about. That means just like we have responsibility to take care of our children, we have responsibility to take care of our family, we must see savings, investing for the future as a responsibility that we must undertake and abide with on regular, monthly, quarterly, or annual basis. So these are the ways we can mitigate risks that are usually associated with real estate investment. There are other risks, procurement risk. How do you identify a good contractor? How do you identify a good workman? How do you ensure that there are no wastages on the site? How do you ensure that when you buy 20 bags of cement, 10 is not being stolen? All those things are risks that have ways of mitigating them. And as we go into it as individuals, we continue to understand how better we can mitigate risk. I will go to the next slide. So where are the opportunities for us as officers, whether junior officers, middle level, or senior officers? Where are the opportunities for us to begin to think how to invest? One is Lagos growth corridors. Lagos have growth corridors. Growth corridors of Lagos, we have the Badagry axis, we have the Lekki axis, Badagry axis, Lekki axis. We also have the Abule Egba Miran axis. Those are Lagos growth corridors. They are areas where government is digressing attention to in terms of satellite town developments. Satellite town developments are developments at the outskirts of the city, where government provide infrastructures that may not be accessible immediately, but for the future. So we must identify those growth areas. Abuja satellite towns too are other opportunity areas where we can invest. For those of us that are in Abuja or that also invest in Abuja, there are satellite towns that have been developed. There are the renewed home agenda scheme that have been developed, federal mortgage bank scheme, federal family home fund scheme that are developed in the satellite towns that we can look up to. Why these areas are what we are recommending as opportunities is because the entry point is low. Their entry points are low. The fund required for you to enter into those areas are very low compared to the city centers. Then the Ibadan growth axis. Real estate business is booming in Ibadan now. Anywhere in Ibadan that you have opportunity to buy land, please investigate properly and invest in it. Ibadan area also have its own growth axis. Then we have infrastructure-driven locations. Infrastructure-driven locations. Area where governments are developing infrastructure, then we should focus on those areas. You have the what is it called? The coastal road, Lagos Calabar coastal road. We have the Badagry highway that is being done. We have the rail lines, all the rail lines from Lagos to Ibadan, Lagos to Kaduna, all those rail lines. We have all the bus stops, the stops where you have bus stops. Any location around those areas that we can invest in for the future. So there are infrastructure corridor for Ibadan. You have the circular road that's being done in Ibadan. So any investment around that corridor is something that is for us for the future. Then I've also mentioned the coastal road corridors. So these are areas of opportunities where we can invest in as beginners that has very low entry point, but with very fantastic developmental potentials in the near future. Can we go to the next slide?
Sir. I'm sorry, sir. Before we go to the next slide, let me kindly remind everyone to please mute their mic so that we avoid interference. Please, sir, let's kindly mute our mics, sir.
Assalamu alaikum. Please take your mics. There are two persons whose mics are on, and I think the interference is coming from there. Kindly check and mute so that we can have a hitch-free presentation, please. Thank you.
Yes, sir.
So
how
does smart investors get advantage over those other investors? So as a smart investor, you must understand that you need to engage professional managers. You must involve professional management. You don't invest your hard-earned income, your sweat, in a real estate investment, and because of your tight schedule, you want to be enjoying passive income, and you go and put that property, trust it in the hand of people that are not professionals. Professionals are individuals or corporate entities that are duly registered, accredited, registered with various professional institutions. The body that is approved to regulate real estate practices in Nigeria is Nigerian Institution of Estate Surveyors and Valuers, being regulated by the Estate Surveyors and Valuers Registration Board. So ensure that your assets, your investments are kept in the hands of companies, firms that are members of the Nigerian Institution of Estate Surveyors and Valuers. For instance, the advantage is that should there be any defaults, should there be any issue in terms of managing your assets, you can always report such a manager to the regulatory board, and they can sanction that firm up to withdrawal or suspension or termination of the license of practice. So let us, as smart investors, take advantage of availability of such a regulatory body to manage our assets. Then we must also lower operational risk. We put in place strategies to lower operational risk. One of the ways to lower operational risk is that in your property or during the development stage, you can have CCTV camera. We have the ones that are not too expensive these days on site while the construction is going on, so that on a daily basis you see what the operators are doing. You can be able to monitor and do it well. And another way to also lower operational risk is to employ capable and competent hands. Don't think because Abba Salau, who is a bricklayer, can do it for 20 naira, and you have a professionally qualified artisan that can do it for 10 naira, and you go for Baba Salau. Sometimes penny wise, pounds foolish. So engage competent hands to be in charge. When you obtain engage competent hands, your supervisory effort and time will reduce. The risk of waste management, waste will reduce, because if you engage incompetent hands, a space that's supposed to be plastered using 1 bag of cement, that person might end up using 2 bags of cement. And again, even upon using those 2 bags of cement, you still stand the risk of rework, because to you and additional time wasted to you. So lower operational risk as a smart investor. Put everything in place to ensure that you reduce risk of operation. Then ensure you have stable returns. Stable Stable returns means that, you know, in economics, say the higher the risk, the higher the return. So you must moderate your expectation. I would rather go into a project that gives me, say, 5,000 every month, and the risk is minimal, than wanting to go into a project that gives me 50,000 every month, and the risk is very high. That of 5,000 is stable. I can plan my future, I can project with it. But the 50,000 is not stable. And that is why most people go get defrauded by Ponzi scheme. Things that sound too optimistic in terms of returns, we must watch out for such investment. They are likely to be trap that our money will go into the drain within the shortest possible time. Again, a smart investor must ensure that there is transparent structure. There is transparent structure. There must be a structure in place that is transparent. The person buying, procuring the material must not be the person applying the materials. You must separate procurement from execution, from monitoring. The person procuring the materials must not be the person to apply the materials, and must not be the person to supervise or monitor the execution. There must be structure in place, and that will allow for accountability, so that at any point in time, you can hold everybody involved accountable for what they do. For instance, if the procurement officer procures 20 bags of cement and hands it over to the executor, he must have signed up to say, I handed over to you 20 bags of cement. So that executor becomes accountable for that 20 bags of cement that has been handed over to you. Yes, you might be looking at it as if what I'm discussing has to do with very large projects. But no matter how small your project is, you can still have structure put in place that is very transparent. Lastly, for a smart investor, you must learn to engage on scalable investment model. Scalable investment model. Scalable investment model enable us to get in at the entry point at the lowest possible and lowest possible quantity. For instance, if you have a plot of land, and what you have is that you can have a mini flat, a room, parlor, kitchen, toilet at the rear part of the development. Then do your mini flat. But the design must be such that it can be scaled. The design must be flexible enough that you can move a mini flat to 2-bedroom flat, and a 2-bedroom flat to 3-bedroom flat. And you must prepare, depending on the development of the environment, the foundation. If the intention is for it to now have it as a duplex, the foundation must be prepared in such a way that in the near future, you can introduce column and then have it taken to another floor. So your investment must be scalable in real estate. You must start small and begin to build it over time. So that's would encourage you to come in quickly and will not discourage you from investing in real estate. Can we go to the next slide? So I want to talk about WEMABOD as a trusted institutional partner. WEMABOD has been in existence for over 60 years. It has proven track records, very strong legal and governance structure in place, and transparent investment framework in place. what are the investment opportunities that you can enjoy as officers in WEMABOD? You can enjoy institutional rental housing scheme. We are working with Pan-African University, Pan-Atlantic University, to develop student hostels. So this is open to people that may want to put in their equity as investors, so that as said, and continue to enjoy annual rental income, get your annual dividend based on the quantum of your investment. So that is open to people that may be interested in that. We have joint development partners. For those of us that have land, it may not be directly, maybe through family. Another way that you can also enjoy income is even through your networking. For instance, you have a family land, not your land as an individual. You have a family land, or you have a friend that has family land, or you have a relation's family land that you can introduce to WEMABOD as a facilitator. Get facilitation fee. Your facilitation fee enable you to go invest into landed property elsewhere as the entry point. You can get your facilitation fee, for instance, if the land is in good location and get as much as 2, 3, 4, 5 million. You can take it to the suburb, get 1 or 2 plots of land, and invest it against the future. Again, we also have structured property investment that we also do. Structured property investment is that we have projects that are ongoing. You can come in either at the early stage as off-takers, where you pay down some amount and spread balance over a period of time. You can also invest in the ones that have been completed that we want to offload and structure the payment plan. And lastly, we also have land banking opportunities. We also land bank. Because of our ownership structure, WEMABOD is owned by the 6 southwestern states: Lagos, Oyo, Osun, Ekiti, Ondo, own WEMABOD. So we have access to government land allocation. So what we do with this land is to land bank it, hold on for a while until we see that there is relative development. So then lay out each blocks for site and service chain. So provide services, infrastructure, and then sell to individual while develop part of it. So those kind of opportunities are available for you to come in at the early stage, either as off-taker for the ones that we're just about doing, or as a structured land bank investment opportunity that you can enjoy in WEMABOD. In WEMABOD too, we also render property management services. That if you have property in choice area that you can bring on board for us to manage on your behalf, you are rest assured that your property will be properly managed. And what that gives you is that your rental income will continue to grow, because the level of management of property also determines how well you can enjoy good revenue from it. If property is not well managed, the rental income will continue to go down. But with WEMABOD, you are rest assured that you can enjoy your rent. WEMABOD is a company you can invest with and go to sleep. There is no issue of money disturbing you. There is no issue of delay in delivering your projects and in terms of quality. Can we go to the next slide, please? One of the projects that we have, fine, this project is high-end project. So perhaps maybe the senior level officers may be the ones that may want to key into it. But junior level officers also can benefit through referrals. If you have people that are interested and have the financial wherewithal to buy, you can benefit by getting your facilitation fee. And that to me is another real estate investment objective. If, for instance, you target that you'll be able to source for, let's say, 10 people that will buy into this, minimum that you get as your fee will be around 3 million each or 4 million each. So if you multiply 4 million by 10, that's 40 million. Good and good enough for you to be able to start your real estate investment. So it's another way of financing our real estate investment. Don't necessarily go into bank. So the jewel of Marina is the first of its kind in the prime in that corridor. We all know Marina in Lagos. The property used to be it is on 21 floor high-rise building. It used to be an office complex, which we decided to remodel into residential apartments. Having understood the fact that there is need for us to bring back 24-hour lifestyle, 24-hour economy into the city center, and we are working with the state government this, so that we create an environment where people can work, live, and play within very close proximity, and also it reduce the travel time of people, rather than most people that live in Lekki, Ajah, and Kodu, traveling all the way from to Lagos Island every day, can secure an apartment here and be there and go home on weekend. You can also have it as an investment because Airbnb definitely thrive in this location. You can have it as an investment that will continue to generate regular income for you. It's a high rental building potential investment, and we are targeting corporate executives tenants. It's a mixed-use ecosystem that allows you to live, work, and earn, and you have flexible payment plan and secured ownership. It's just 74 units of 1 bedroom, 2 bedroom, and 3 bedroom apartments. Unfortunately, the 1 bedroom is sold out completely. We still have 2 and 3 bedroom apartments available. Of the 74 units, we have just 19 units left. So it's an opportunity that we may want to consider, either as for ourselves, for anybody that we know that we want to invest in a secured real estate that has the capacity to generate stable and secured rental income over time. So this is the jewel of Marina that I'm just introducing to us. Next slide. So Serenity Sugarland Estate is another estate that we have within the Lekki corridor. You know, I talked about the growth corridor, growth area in Lagos State. Lekki Ajah area is one of the growth area. This project is near DGC, and it has high capital appreciation corridor. We all know that the development model is a shell model. So we are only developing the carcass. When we say carcass in this instance, it will be plastered both internal and external. We provide the first fixes, which is the piping, and we provide the other infrastructure that makes living very, very habitable. We provide generator, provide solar lights, water treatment plant, and all what's not. That's why we have adopted the model of carcass. We call it Polish carcass. Is that from our experience, we find out even if you develop a complete building and you sell to individuals, 90% of the buyers will still come in and change most of the things that you put in there. They are likely to change the sanitary wares, change the electrical fittings, some even change the tiles, some change the POP, and so by the time such a person, assuming such a person bought that property for, let's say, 100 million, he might end up spending another 50 million to now change everything that he has in there. So rather than buying that property for a complete property for 100 million and still having to 50 million to change most of the things, especially because of the quality of those finishes that you have there. Rather than buying them, you have now ended up spending 150 million. Why not buy carcass at 80 million that you can spend additional 20 million to complete and you have 100 million? So that is why we have adopted that approach, and it's in a very secured and serviced environment. We have flexible payment plan. There are 30 units of 4-bedroom semi-detached triplexes with 4-bedroom terraces too, both with mixed room and in very good environment. We have very flexible payment plan. Like I said, it's an opportunity for you to get finance to invest in your own real estate opportunity as a facilitator. If the amount is on the high side for us to be able to put down, we can get people, we can get our major generals, our ogas, introduce it to them, and let us know you are the one that introduced it, so that you can enjoy your facilitation fee that will be an opportunity for you to grow your own real estate investment, like then scale over time. Next slide. Apapa Development House is another interesting project that we have. We are about to start around the Apapa Lagos Port corridor. It's a prime Apapa location because of the closeness to the port and logistics corridor. Like it's also, it used to be an office building on 9 floors too, but we are remodeling it to a mixed-use residential and office complex. Like I said, part of our 5-year objective as an entity is to help to develop our city center. We are shouting that there is housing deficit in Nigeria, but if you walk through our city centers, you see a lot of abandoned properties, mostly office buildings that are abandoned. Our belief is that one of the ways to solve the problem of housing shortage in Nigeria and to make housing available for all of us, including the officers at various levels, is for us to look at all these brownfield development within its centers that are abandoned and were either to be used for other purposes, and remodel them into mixed-use apartments where people can live and also recreate and earn resources at the end of the day. So this building is one of such that I've considered to remodel into residential apartments. It has strong residential rental demand from professionals in the area. We have companies, industries in that corridor. We believe that if you invest in this kind of apartment, your income, your return on that investment is surely guaranteed. It's you have low big back to life. We have a lot of properties in Apapa which were affected by the decay in infrastructure some years back. But with the government effort and the recent federal government investment in Apapa, the Apapa is coming back to life. Most of the residents so that give us that the rental cost in Apapa is increasing. So if you invest in this kind of initiative, then you enjoy very low vacancy risk. Then the stable rental too. Good institutional backing. So the fear of whether when you put your money into it, project will not be completed is not there. The fear whether the project will not be completed to time, cost, and quality is not there. We have a lot of very complex developments in the so make the dream come. So these are opportunities for us, for those of us that also operate within and around Apapa, or that have people within Apapa that may want to invest in this kind of
Assalamu alaikum, sir. I think your audio is not clear, sir. Assalamu alaikum, sir.
Alaikum salam wa rahmatullahi wa barakatuh.
Sir, I don't know whether it's from my end, but I can't hear the guest lecturer from my end, sir.
I also can't hear. He also, yeah, I can't hear him also. I can't hear him also.
Yes, sir. So I'm
hello,
trying
can
to
you hear me
connect.
now?
Okay, sir. We can hear you now, sir.
Okay, I think it's more of time. Please, I want to say a little speed. Pardon me. I know I had 1 hour, but I can see that I've spent beyond that. It's because of the passion I have for it. I don't know when next I'll have opportunity to speak with you. So I have to load it with a lot of things that I know I must share with us. So what is the practical roadmap if you want to invest or start investing in real estate? One, you must define your income and savings. You understand what your income. When I say income, you could have more than one sources of income beyond your salary. But the most important thing is understanding all your sources of income and define them. Some income are regular, as in their daily income. Some are monthly income, some are quarterly, and some are yearly. So if you define your income, you'll be able to define your savings. How you want to save the income you are earning. Then, secondly, you choose your investment type. Having understood your income level, having understood the kind of various types of income that you earn, then you choose your investment type. Your investment type, is it the type that you want to buy in? If that is the kind of income, your sources of income, the type of source of income can accommodate you buying and paying at once, then you go for it. But if you cannot accommodate that, then you have to choose the type of investment that you want to invest in. Number three, you set a 5-year goal. I always encourage you to set a 5-year goal. Real estate investment is a long-term investment. Set a 5-year goal for your investment. There is what we call indigestion. Again, that's another thing. You must avoid indigestion. Indigestion is that you have not completed this project, you move to another project. You have not completed this project, you move to another project. At the end of the day, you have 5 uncompleted projects. That means you write down capital. Write down capital. So when you have first investment project, ensure that you work around it to make it to be income generating. Then you move to another one, unlike 4, 5 projects. That's what we call indigestion. So you set a 5-year goal. Give yourself 5 years. Within which you want to grow your investment in real estate. That gives you opportunity to begin to start and invest. Then 4,
so the I'm okay with the clip. I don't know what's the mother and he will now. If you are okay, then
Amir,
Assalamu alaikum, sir.
Amir, you are interfering.
Assalamu alaikum.
So I request your audio, sir. Your audio was left on, sir.
Okay. Sorry, please.
Yes, sir. Yes, lecturer, I can continue, sir.
Action. Don't delay. Take action.
So we cannot hear you, the guest lecturer, sir. So we can't hear. You're not audible, sir. Assalamu alaikum, sir.
Yes, I just told us that we should start, learn to start small, take action immediately, don't delay. Or please, especially this slide that I'm discussing, sit down, review your sources of income, plan out how you want to start saving, choose the investment type, and take action immediately. Next slide, please. So your journey to start investing and create wealth starts now. Real estate success is about early entry and growing consistently, not just buying the most expensive property first. Not just buying the most. If you want to wait to have the resources to buy the most expensive property, you might wait endlessly. And what happens between that period is that you'll be spending money on things that are liabilities. Buying expensive cars, buying expensive wristwatch, buying expensive wares. Those things are temporary, and they are liabilities at the end of the day. They fade with time. But real estate investments is about entering early and grow it consistently. So no matter how little, early, define your goal, pick your partner wisely, focus on long-term rental income, because what you are doing is to prepare for retirement. Then start building your legacy today for a secure retirement. Ladies and gentlemen, don't wait to invest. Invest to wait. Do not wait to invest. Invest to wait. That what that means is that don't procrastinate. Don't waste it tomorrow. Invest now, no matter how little, and wait for it to grow into the future. Thank you very much. I would expect questions so I can provide answers where necessary. I also don't know it all. So if for any reason I'm not able to answer your question immediately, I'll send the answers to the coordinator, Abu Malik, so that he can make it available to us. Thank you for listening, and I appreciate your time.